Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Beko, and we have a special guest today in this episode, Abhishek.
Hey, welcome. Thank you for inviting me on the podcast. I have actually heard a lot about you guys, and I'm a continuing listener of the podcast as well. It's
Exactly.
exciting to be here.
Yeah, that's awesome. Well, really excited to have you here today. And one of the reasons why I was excited to have you on, and for you guys who are listening, you guys know that in the recent episodes, I've been inviting professional fund managers to the podcast, and of course, they have really awesome things to say about investing and particular companies they're interested in. But I thought, this episode we invite people from the community, people who are listeners of the podcast who are not professional money managers, but equally produce very, very good content in terms of research. And so Abhishek is actually, in fact, part of our Slack community, Slack channel, where you can talk to me directly, you can talk to the community, and there he had posted a awesome analysis of this company that we're about to talk about today. And so I extended an invitation for him to come onto the podcast. And I think this should, I really want this to be an encouragement to people out there who are new to this or who are not, professional money managers, that, don't be disencouraged by the difficulties, the seemingly difficult. It is a difficult task, but it is not an impossible task, and you can definitely do it if if you stick with it and if you have discipline and go through the process. So I just want this episode to be an inspiration to a lot of people, and I want Abhishek's work to be an inspiration to our listeners. So really excited to have you on in this podcast.
Absolutely.
Yeah, just a little bit about Abhishek, and I want to toss it to him to go into the meat of the podcast, the company that we're about to discuss today. It's actually quite fitting, the company that we're about to talk about, because Abhishek himself, he is he's been working in a construction company for the past 5 years, and the company that we're about to talk about is a REIT, in fact. So there's a big relevance. But he has always found learning about investing and business very, very interesting, inspired by Charlie Munger, Warren Buffett, and Mohnish Pabrai. He's in fact actually looking for an opportunity in investing from a professional standpoint. So he's looking to transition out of a construction company into he's right now a engineering project manager. Did I get that correctly?
Senior project engineer.
Senior project engineer, and he's looking to transition into investment field. And I will put the link down below in the comment box in the description section if you want to reach out to him directly, his Twitter account as well as his blog. So enough for that. I'd like to go right into the meat of the podcast. So, can you tell us the company that you've done research on and who they are, what they do at a high level?
Yeah, absolutely. So at a high level, SERITAGE Growth Property that we're talking about today is a retail mall REIT, which was basically spun off from Sears with an intent to redevelop its old Sears properties into retail, mixed use, and residential communities. And with an average rents of 4 times that Sears was originally paying. So Sears management wanted to spun out this real estate piece because Sears had a very good locations all around the country, and there was a lot of value out of these properties that they were holding into.
Mm-hmm. Just to recap there, I think there's a couple of really interesting things that is at play here, which is that, number one, it is a REIT, right? For those of you who don't know, REIT is Real Estate Investment Trust, and it's a special type of vehicle to kind of host real estate properties, right? The major benefit of that being that being the tax benefit of being a REIT, right? That's the main benefit of being a REIT. That's number one. Number two is that it is a spin-off, right? So it tends to happen that a lot of interesting REIT that I've studied are actually spin-offs of a of a previous parent company. For example, I think a big one is the big one, the most famous one people talk about is off of Marriott, right? Off of big hotel chains, they lump real estate portfolio into a separate company, and then the hotel management stays as a parent, as a parent company, and or as a separate company after the spinoff. So after a spinoff, these two entities become two separate entities, and it is usually done to unlock potential value that was hidden in a parent company, right? If you were to value a real estate portfolio versus a management company, is a very different model. So a lot of times people spin that out to unlock the value that's been hidden underneath an umbrella company. So interesting stuff here. Sears, obviously, everyone knows is it's kind of a dinosaur at this point, right? I mean, no one really shops at Sears, but they have a ton of real estate properties that's valuable, and so this company is looking to take advantage of that undervalued assets. So fantastic. So let's move on to again just a couple of housekeeping items that I forgot to mention. In our podcast, right, we go through a checklist, right? A checklist to make sure that we stay disciplined to the process. We don't forget anything. So if you guys want a copy of our checklist, please email us at info@valueinvestor.org. info@valueinvestor.org. We can send out a copy of the checklist, and this is what we're going through today. So that was the first question. Let's move on to the second question. Does a company have a competitive advantage?
Yeah. So it's I was looking through your checklist that you sent me, and it does have a competitive advantage, but it's not in traditional metrics. So traditionally, I see that the competitive advantages include brands, network effects, switching cost, or if it is a low-cost producer or has intangible assets. Seritage in itself does not hold any of these competitive advantage, but has a very valuable and highly populated and densely populated areas of properties that their value is basically still there. So it does not necessarily hold any of these four, but it's a non-traditional competitive advantage, if one may say.
So, for example, well, let's ask some of the more fundamental, basic questions. Like who are the tenants, and what kind of real estate portfolio do they run? Do they run commercial real estate, or
So
give us a little bit more color on that.
Yeah, just to kind of like give some few details out. So Seritage right now has about 199 properties, which are about 30 million square feet of real estate. And then the location of their properties is it's around household income of $95,000, as well as the density is about 650,000 people within 10 miles of all its properties. Talking about tenants, it's mostly retail tenants, as you know that it was spun off from Sears. So these were basically originally Sears properties, right? And they were re-tenanted, developed and re-tenanted to other commercial and retail retailers like Bed Bath and Beyond, Dick's Sporting Goods, At Home, Burlington Stores, Ross Dress for Less, as well as they were also rented to fitness clubs and entertainment centers like Dave & Buster's, 24-Hour Fitness, and Planet Fitness.
And tell us a little bit about the geographic footprint, right? Are they mostly concentrated in the East Coast, West Coast? What does that look like?
Yeah, so if you look at their presentation, they are about 40% densely populated in California, Florida, and East Coast, 49%. But they are all over. They are in Texas, in Arizona, as well as other states as well.
I see. That makes sense. So just to recap there, so a lot of the tenants here you're talking about, businesses, right? Retail business, fitness business, maybe perhaps the Sears competitors, right? Would be buying into these properties, and they're sort of geographically well distributed, even though there are some pockets of concentration. Did that summarize it well?
Yeah.
Okay. Great. So from that perspective, real estate is a real estate, not really a strong, competitive advantage in terms of traditional kind of categories that we talk about. But having said that, just by the very nature of that of the fact that Sears has been operating in these big kind of centers of densely populated areas. That in itself, just the location-wise, is an advantage. Okay, so let's move on to the next question. I think this question is an interesting question given the fact that we are now, right, in pandemic, and people are questioning the return of commercial real estate and what that means, etc. So let's move on to this question. How durable is the competitive advantage? What are the risks to the current competitive advantage?
Yeah, from the analysis that I did, it seems like these properties might be worth somewhere between $3 to $3.5 billion, and this is backed by individual property transactions that were carried out in the last 12 months, as well as the properties that they sold within first 9 months of this year. Originally, these were valued at about $2.7 billion in 2015 for 40 million. And their competitive advantage is still there because they're still able to sell these properties at the valuation that they hold. Even if we assume that we are in a distressed situation and the property values get distressed, which happened in 2008 as well, the lowest that it went in 2008 was about 20 to 30%, right? So if you do the same multiplier and bring this value from $3.5 billion to say $2.4 billion, and they have a debt of about $1.6 billion, the remaining equity is still equivalent to the current market cap. I would like to add that Seritage was actually able to develop the 10 million square feet. They were able to sell the 10 million square feet out of the pie of 40 million and use that cash to develop rest of the properties. And they were also able to identify some of the crown jewel properties that they want to further densify and add more leasing space to it.
So are they looking to kind of trim down their portfolio, sell the ones that are not performing well, and use the cash that they generate from selling some of these properties and renovating them, making these properties better, right? Is that the
Yeah,
strategy?
that's kind
And
of like has been the original thesis since 2015, and so far they are in this transition.
yeah, so that makes sense. So has that trend been accelerated? So is the company selling more assets to renovate more? I think you called it crown jewel, like the really
Yeah.
important assets that they hold. What has been their strategy, and are they looking to grow? What does that look like?
So they have identified, but then as you know that you have to capture the space, then you have to go through the entitlement process. You have to find the tenant and start developing that property, right? So it takes about 18 to 24 months for a property to from capture to develop and release, right? So they have
Hmm.
been doing about 2 million square feet a year of development. And until pandemic, they were also leasing about 2 million square feet a year. And so I think they have been doing a great job. But then even with the pandemic, they've been able to sell the properties and use that money to fund the development. And it seems like the crown jewel or 6.5 million square feet of space is likely to come online in late 2021 or 2022. When I talk about in terms of the dollar amount that they invest, they try to do 300 to 400 million dollar of capex every year, which equivalents to about 150 to 160 square feet of development cost to develop 2 million square feet.
I see. So if we just take time to, let's say, infinity, what they would end up doing is they would just chop off underperforming assets and then keep the ones that they have, make it better and make it better and make it better. But they're not looking to go out and buy more assets.
Not at the moment, but that will certainly be a strategy once the whole portfolio is stabilized and the properties are rented and they're giving extra cash flow out of it.
Yeah, that makes a lot of sense. Okay, great. So let's move on to, I think we kind of touched on this. What are the company's long-term prospects and runway for growth? Maybe you could talk about more, you can maybe add more color to what you said about these properties coming online in 21 and 22 and then further down the road. What
Yeah.
does that look like?
So I think I do want to touch on the previous question of the what are the current risks, right, in this competitive advantage.
Hmm.
And the risks are basically a management execution. It can be a long, slow death, right? Management has no incentive to liquidate the property and give it back to shareholder, right? They have to keep up the payroll and they have to get paid for anything. So it could be a long slow death where they could actually just keep selling all the properties to survive and until they cannot survive, yeah, right. Then they can also make poor choice of tenants, right. In the rush of signing new leases, they can make poor choice of tenants, and instead of making a class A property, they could have a class B property. And then they can be in the cash crunch as well right now. And there is another interesting point that they have a lot of JVs done with the big other REITs like SPG. But then those developers are basically sitting on it. They are not developing these JV properties because they think that, oh yeah, Seritage can go down and we can get these properties at a liquidation value. So these are some of
Hmm.
the risks that I did want to highlight up front, and we can go into it later.
Yeah, that's fantastic. Okay, great. I think we could talk about this later, but
Okay.
just a level set. I think we didn't touch on this, but I think it's important to do this. Just a level set. Could you describe their, their market cap, their top line, just roughly? Like what is the ballpark range we're talking about here?
Yeah, so their current market cap is about 800 million. They have a debt of about 1600 million. Their current rent is about 97 million. Their expenses are basically operating expenses and taxes that range about 60 million, and overhead is about 40 million. So their rent kind of covers their basic expenses, but they also have interest of $112 million that they have to pay to Berkshire on their debt. And this is what they are basically they're getting this money from sale of assets, and they're using that to pay the interest and fund the capex, right. But there's an
Hmm.
interesting thing that happened in quarter 2 that they were able to amend their contract of the term loan and defer the interest if the cash levels were to go down. So for example, if they just want to keep on developing for next 3 years and defer the interest, they can technically do that if the cash levels are at like minimum lows. That's the
Hmm.
amendment that they were able to do. So Berkshire
That makes
was
sense.
definitely backing their development.
Yeah, it makes sense. We could talk more about that in the second part of the episode when we talk about the financials. But that's a good color to add as we discuss more about the fundamentals of the company here. Okay, so we talked about long-term prospects. Actually, yeah, could you I guess back to my question, could you talk about the long-term prospects, right? 2021, 2022 coming online, they're renovating a whole bunch of space. What does the future look like for them?
Yeah, so in the near term, what it looks like is that for next 3 years, they will be developing about 6 to 6.5 million square feet. They have about $68 million worth of properties that have signed leases and that will start paying rent in next 12 to 18 months. So that rent is coming online, and they'll probably invest about $1,200 million in next 3 years to just fund that capex of 6 million square feet, right? And the way that they would get this cash is by selling their undeveloped assets. And I think that their undeveloped assets of 10 million should be worth about $800 million, and they have additional credit facility approved by Berkshire of $400 million, given that they can reach their annual rent up to $200 million. So I feel like they would take this capex, develop the properties, and try to rent them as soon as possible to increase their annual rent from 97 to about 250 to $300 million. That's basically the game plan.
I see. So just to recap there for a second. So basically, sell some of these assets, get financing, right? I think the key thing here is like the company is really looking to secure financing and have secured financing from Berkshire and otherwise. Make sure that the capex is spent wisely, and then really hitting the mark in 2021 and 22 and beyond. But right now it feels to me that from what you're telling me, it feels to me that they're really focused on trimming their assets to only the crown jewels, securing financing to do capex, additional capex. So that would add on to the money that they would get from selling these properties, plus additional financing equals better property, better real estate portfolio for the long term. Does that sound
Yes.
right?
Yeah.
Okay, great. Okay, moving on to the next question. I think this is, we talked about this just briefly, I guess, before, but you'd mentioned, right? You'd mentioned the capex, right? The capex involvement, and so the question here is: does the company require a lot of capital reinvestment to maintain its business, and can it grow without any further investment? This is obviously very important one, given the fact that it is the REIT business, right? Real estate business generally is a capital intensive business. And so let me ask you this question. What do you think about them?
So I think the short answer is yes. If you have properties that are generating enough rent to cover your expenses, then you can kind of like sit back and you have more freedom to pick and choose which properties you want to buy and develop, right? And you have some selection there. But given where Seritage is, that they are in this transition, it's almost like a race against time, that they have to really focus on all the capex, get it done, release it, get the rent, and pay the overheads as well as interest, and try to reduce the debt.
Right. That makes sense. Just looking at the financial statements here, and we could talk about this more in detail next. Capex, making sure that there's enough money for capex and just building out for the future, right? Short answer, yes, it does require capital reinvestment. But here, really what's important is capital reinvestment in the short time horizon. This is the critical moment in the business where you have to execute this perfectly in order to really step it up to the next level. Right? With COVID, there's a lot of uncertainties. Really making sure that the capital reinvestment, capex, stays afloat and the company's able to maintain its properties and make it better. Sorry, you're going to say something?
Yeah, I do wanted to add that while the long-term portfolio of undeveloped assets has a big time horizon of 5 to 10 years because it takes a
Mm.
long time, the short-term goal would be to develop at least 6-7 million square feet, rent it, refinance the mortgage from 7% to maybe 3 to 4%, because these properties will be stabilizing after the rents, and pay off the debt. Once they do that, they can maintain the cash flow and they will still have approximately 10 million square feet of undeveloped assets. So they will be in a much comfortable position once the debt is financed to the property level, and they have enough undeveloped assets to move the ship the way they want it. But right now, it's almost like a race against the time.
Right. Oh, that makes sense. And what's the time horizon you're talking about here?
The short term would be at least 3 years. So
3 years.
they would really have to perform well in over the next 3 years.
I see. That makes sense. Okay, let's move on to the next question. Does a business have favorable relationships with the following? And usually, we don't really go through them one by one. We just call out any red flags that you see, right? Any red flags that people should know about. Do they have any red flags with respect to relationship with customers, suppliers, employees, regulators, or community? Any red flags that you want to call out here?
No, there are no red flags. Think about it. Customers want better experience of retail. Customers want to have experience-oriented retail these days. It helps the suppliers. Employees will be definitely benefited by the development and the capex. And regulators, right? Think about new cities being developed around Sears or existing locations, right? It helps. It boosts the economic perspective of that area if there is a better real estate around. So it actually helps a lot of people.
Fantastic. Great. That brings us to the end of the first episode, where we talked about the fundamentals and kind of the high-level qualitative aspect of this company, SERITAGE Growth Properties. I think just to quickly summarize, this is kind of a classic kind of value investing, right? You find a company who holds an asset that is not valued properly by the market, right now in this case, they have a whole ton of real estate portfolio. They have a real estate portfolio. It's a REIT whose property isn't being valued properly, right? The equity is not being valued properly, and so that's kind of that's a big story. And then underneath that story, you have interesting kind of innovative, I guess not innovative, but the sub stories of that, which is the company is selling off portfolio, some part of their portfolio to finance innovation projects on the existing portfolio. The crown jewels, really furthering the attractiveness of the crown jewel portfolio by selling off some of the underperforming ones and securing financing to make sure that can be delivered. And the timeline horizon we're talking about here is about 3 years, critical timeline where SERITAGE really needs to execute on this promise. Fantastic. Awesome. I think it's promising, but I think more will come out in the second episode because, again, this is fundamental kind of value investing, looking at assets that are being undervalued. So in the second episode, as we always do, kind of we go through the valuation exercise. So that's where I think the meat of the story is going to be. So stay tuned, and any last words, Abhishek?
Yeah, of course. I think I do wanted to summarize that the meat of the story here is that SERITAGE is difficult to value because of depressed financial metrics that it currently has, and the solvency concerns. But if you look deep dive into individual properties, it seems to be worth more than what the market is willing to quote for it. And on my end, I think I write a blog about my investments, and I have this analysis posted on it as well. I'm definitely trying to reach out to the community, the professional community, to get more insights and learn from them, and professionally get involved into investing. So if there are any postings out there, I would love to be contacted and be part of.
Excellent. Thank you so much. And once again, I think this episode, I hope this episode serves as a motivator for people out there who are not professional money managers, professional fund managers, to get into investing, right? You can do this on your own, especially, right, Abhishek, working in the construction industry. He has insider information about how REITs function, things like that. You can start off there, right? You have your own competitive advantage, the circle of competence. Right? You can use that to value companies that other people cannot. And that's a real advantage there. So I hope this podcast and Abhishek can be an inspiration for our listeners. Awesome. Thank you guys for listening, and I hope to see you guys in the next episode. Thanks, guys.